Okay, this is first session we are having this for this DIP-IFR syllabus. So this is what we say that conceptual framework, it actually provides you the basis, the guidance, the fundamental conventions and the principles upon which all of the IFRS standards will be built. Now, last time conceptual framework was updated in 2018. Before that, it was given in 2010. And then before it was in 83. First time it was
दरवाजा
given in
बंद कर दे, वीडियो
1983
देख रही
and
है,
so
बात कर
on.
रही है
So we are
वीडियो देख
following
रही
the
है, बात कर रही
conceptual
है
framework which is from
क्या वीडियो देख रही है,
2018.
बात कर रही है, बाप अपने
And
फूफे
actually
से
it's the
करूंगी।
same one, but there are
अच्छा
very
वीडियो देख
few
रही है तू,
definitions
लाइव
which they
चल
make
रहा है
changes. So
तो
what is
तेरे
a
नहीं आ रहा कुछ भी
conceptual
है,
framework?
फिर
A
म्यूट कर
statement
रखा
of
होगा।
generally
हाँ
accepted theoretical principles which form a
इसलिए
frame
होगा।
of reference for financial reporting. You should remember that the IFRS standards and IAS standards, they give you two things,
दरवाजा पूरा
one
बंद कर
is
दे।
which is called guidance and one is which is called judgment. Guidance is something which is clearly explicitly told to you in it through standard that how you should do application or what you should apply. Okay, so guidance means where the standard is telling you what to do. And then there is another thing which is called judgment. Judgment means that you decide. The standard is silent on that. The standard does not tell you what to do. The standard only tells you that these are the principles or this is the conceptual framework, and you make your own decision. And this is where we use the word frame of reference. Frame of reference means that when I'm taking a judgment, when I'm taking a decision which is a judgmental based decision, I make in my mind sure that I'm not going against the conceptual framework. And whatever application, whatever decision, and whatever application of IFRS I'm applying, this is in line with the conceptual framework, the fundamentals of conceptual framework. For example, I have to take a judgment, but my judgment should not be against the principle of prudence. My judgment should not be against the concept of accrual. My judgment should not be against the concept of consistency, and so on. So it ultimately becomes a frame of reference. Frame of reference means to which you measure it. These provide a basis for developing new accounting standards and a platform to evaluate those already in existence. So this is like the principles which are given in conceptual framework. They become basis for creating the new standards. Advantages of conceptual framework. Of course, it's very common, it's simple, that the advantage is that once you have one conceptual framework, which means the rule of the game, it means it gives you it puts you in a position that your financial statements would be consistent because your IFRS standards are consistent. Everything is based on the same conceptual framework. The development of standards is less subject to political pressure because you are not following or taking any political pressure. In fact, you are following to your how to say conceptual framework. I'll give you an answer. How do I see this conceptual framework? Actually, if you see standards, I can consider or think like that standard are particular laws, and conceptual framework is like constitution. In any country you have got a constitution, and then you've got different types of laws, your tax laws, your labor laws, and so on, your criminal law and civil law. But none of the laws will be against the constitution of the country. The same is the importance of conceptual framework. Conceptual framework is like the constitution, and then based on that you develop or prepare different standards, and all of them are in line with conceptual framework. A consistent statement of financial position driven or profit or loss driven approach is used. Disadvantages of a conceptual framework. Yes, that is also something we should be talking about, although we can't do anything about it. So we say that financial statements have many users, all with different needs. And I will tell you here very practical reason that where this conceptual framework tends to fail or tends to fail to satisfy the needs of the users. Now remember that your financial statements, you've got different types of users. Okay, you've got employees, you've got shareholders, you've got lenders, creditors, you know government, tax authorities, and all of these users, they have different needs. uh, they have different expectations from financial statements. Now, your suppliers, which who is your creditor, they're not really interested in seeing the profitability of the business. They are more interested in liquidity. Current investors, they have a different perspective. Future investors, they have a different perspective. So based on that conceptual framework, the financial statements which we prepare, these financial statements are not capable of justifying the needs of everyone. To help you understand this thing better, I tell you one thing. There is a concept which we use here. We call it, the concept of prudence. Okay. Prudence concept, what does it say? Prudence, it tells us, or it says us, that we should be, when you prepare financial statements, those have to be prepared on conservative. Okay. Conservative approach. Now, what is conservative approach? Conservative approach says that income and assets, when you estimate them, you take the lower estimate. And when you take expenses and liabilities, when you make estimates, you take a higher value for this estimate. Now, after applying this thing, I mean, you are creating a provision, you are thinking about future losses, you are thinking a bigger number. You are talking about asset valuation, you are taking a smaller number. Okay. So it means that you are being prudent, you are being conservative, which means that your financial statements are seeing the worst side of the picture. You are thinking about worst come worst. So you are not showing a very rosy picture. In all the instances, you are thinking about if bad happens or if this happens. So you're always preparing yourself for, getting ready for the worst. Now, this is where one problem arises. So when you prepare a financial statement, sometimes we call it over conservative. Over conservative means that, wherever were expenses and liabilities, I was increasing them. And whenever there were some assets and income streams, and I had to make a choice, I was taking a smaller number, the estimate I'm talking about. Remember, there are two things in your financial reporting. One is called fact, one is called estimate. Fact is something which is there, which has documented evidence, which has a contract. Fact is a fact. You cannot change the fact. You have got an expense 1,000, it is 1,000. You've got expense million, it is million. You cannot make it more, you cannot make it less, because it has a documented evidence. This is called a fact. But your financial statements, they also include estimates. Estimates are not facts. These are your estimates. For example, depreciation. It is your choice which method to use. It is your choice how much life are you going to take. For example, you create provisions. For example, you create bad debt allowances, against some doubtful debts and receivables. So these are estimates. And your financial statements, your income statement, it does have, expenses coming from provisions, expenses coming from bad debts, allowances, expenses coming from depreciation. So being prudent means that you will take a bigger number for these expenses. Higher expenses you should take on the higher side. So you've got, many estimates in your financial statements, and in all of these estimates you were prudent, you were conservative. And then what happens, that as a result, the income statement which you will produce, it will show probably less profit, because you have absorbed all the conservatism into it. So if I think about, now my question is that, okay, this is a financial statement which has been prepared very prudently, which has been prepared being conservative, but don't you think that it is over conservative? Because you assume that all the bad things will happen to you. All of the expenses where you made estimates will be on the higher side, and all of the incomes and assets you took it on the lower side. So if there were 20 if possible events, you took 20 worst outcomes. In reality, it is not going to happen. Maybe some of them will fall on that side, some of them will fall on the better side. But when we use this conservatism, we produced a financial statement which is called overprudent. Now, this is the point which will not justify the future investors. Now, if you consider a potential future investor who wants to invest money in a business and he sees the financial statement and he might not be very much impressed, he might not be very much happy or attracted because he sees nothing inside. He doesn't know that it has been, you know, overly
बोल ले
prudently prepared. So you need to, and by the way,
मैं
this
देखती
is
हूँ
where the CFAs, the financial analysts, when they take financial statements, they start making adjustments. They say, okay, this financial statement says that the business is making 10 million, or it is expected, or it is making 10 million profit, and but it has been, prepared being overly conservative. If I take away the impact of conservatism, the profit should have been 12 million, because there were some non-cash expenses, there were some allowances, there were some provisions which you created, which probably you need to adjust for that. So a financial analyst might adjust the profitability.
भाई
So
चावल
this
दे
is
दो
where we say that financial statements have many users, and all with different needs. Your current investors, future investors, your creditors, employees, everybody wants to see a different thing. Single conceptual framework does not satisfy everything. A single framework cannot satisfy the need of all users, and therefore other users, they might have to take the financial statements and then use their brains as well, and probably they need to make some adjustments as well. There may be a need for a variety of accounting standards, each produced for a different purpose with different conceptual bases. Now, this is something, a wish list, okay? A wish list item that you should be having, multiple approaches for preparing financial statements for different user groups. It is not happening now, and I don't see it happening in near future. So having a conceptual framework may not make it any easier to prepare accounting standards. Anyways, we just move on. I explained this. Then we talk about the framework scope. And by the way, remember one thing. First, we have the conceptual framework. Based on the conceptual framework, we prepare the accounting standards. We do it so that the accounting standards should not conflict with each other. Everybody is following the same conceptual framework. However, you will face sometime, it is possible sometime, that an IFRS standard and conceptual framework are in conflict. Conceptual framework says go left, IFRS standard says go right. What should you do? Who should you follow? If you see that there is something which is, some overriding, or there is something, a deviation between, or a conflict between an IFRS standard and a conceptual framework, in that situation, what you should do? The answer is follow the IFRS standard. Although conceptual framework is more powerful for us, but when we created the standard at that time, the the standard setters, they already have considered that deviation, and they have created that deviation. So you should be following the IFRS standard. Okay, this is one point you should remember in application. So the framework addresses the objective of general purpose financial reporting. So what is the purpose of financial reporting? General purpose of financial reporting is to provide the information about financial performance, about financial position, and about changes in financial position to different, uh, users for making economic decisions. So objective is to provide information, financial performance, financial position, and changes in financial position to the users so that they can make economic decisions. This is the purpose. And the framework solves this purpose. The framework helps you prepare the financial statements which would be used, or which would be relied upon in making economic decisions. And then you have qualitative characteristics of useful financial information. Financial statements and the reporting entity, we are going to discuss elements of financial statements. We will talk about recognition and derecognition, we will speak about. Okay, so these are the areas where your framework talks about. For example, when you say that you've got income, expenses, asset, liability, and capital. We say these are 5 elements of financial, 5 elements of accounting: income, expenses, asset, liability, capital. Who told you these things? Financial, these elements of financial statements, the framework gave it to you. The framework told you. And then you say recognition of transactions. So what are the recognition criteria for assets and liabilities? Who told you? Framework tells you. And then we've got measurement. It's, how to do measurement. So, and presentation and disclosure. Actually, if you consider, the framework deals with, and the IFRS standards as well, they deal with different areas in accounting. And when we say that a standard addresses tangible non-current assets, okay, IS 16 PPE, property, plant, and equipment. So if it is PPE, property, plant, and equipment, and it is IS 16, what am I looking for in IS 16? What IS 16 is tell me? It is going to give me guidance. So it is going to give me guidance in which areas? So there are 4 areas you should remember, okay? There are always 4 areas. First one is always, we call it recognition. Second is measurement. Third is presentation. And fourth is disclosure. Okay, 4 areas we talk about: recognition, measurement, presentation, and disclosure. So if a transaction takes place, the first thing is that you recognize it. You understand, what is this transaction? Is it my asset or is it my liability? Is it my revenue or
मेरे
is
को
it
भी
my
मेरे
expense?
को
What
इधर
is
दे दो
it?
इसको बिस्तर में
I
नहीं
mean,
देना
that's very true. You don't,
टेबल पे आ जाओ
sometimes there are some transactions which apparently look like to you as a revenue, but they are your
क्या
liabilities.
कुछ
I'll
नहीं
give you an example. For example, you receive,
तेरी क्लास खत्म हो गई
you receive
है
money from your customer, you
डैडी कुछ
receive
नहीं
cash from your customer,
अब
and
बता
that is in
तेरी क्लास खत्म
advance
हो
for
गई
the next
नहीं
year.
अभी कहाँ 2
So when
घंटे
you
की है
receive this money, $10,000, don't think it is your revenue. It is actually your liability, because you have not provided any service. So unless or until you provide service, it remains as a liability in your books. So that's a very simple example, that you are receiving cash and you invoiced your customer paid you the amount, the money comes to your bank, you might be very happy that I got $10,000. That's not revenue. That's a liability. It will become revenue when you will deliver the services. So first thing is, you need to understand, what is this transaction, okay? Is it my revenue or is it my liability? Is it my asset, or
अरे बंद कर दो
or should I
ठंडी हवा लग
recognize
रही
it as an
है
asset or not? For example, in case of intangible assets, many times we see that some of the assets are there and you do not recognize by mistake, or some assets you are trying to recognize but you should not be. So you need to see the criterias. Should I recognize it or not? And if I'm recognizing it, what is it? First point. The second thing is, okay, if I'm recognizing it as my asset or as my liability, the question is, how much is the amount? And that is a very logical sequence. First, recognize, second, measure, because I have to put it in my books. And if I have to put it in my books, I need to know the amount. So measurement comes in, and then you have different valuation methods for different types of assets. Okay, historical cost, replacement cost, economic value, you've got fair value, you've got book value, you've got net realizable value. Different types of measurement they have told you. So the second is, how do you measure it? Second thing, the second pillar. And the third pillar, okay, I know that it is my asset and I have already calculated it. This is how much it is. The third thing is presentation. Where should I show this in my financial statements? Is it going to be shown in my income statement, or should I be showing it in my balance sheet? If I put it in my balance sheet, is it my asset or is it my liability? Or if it is my asset, is it my current asset or is it my non-current asset? Where am I supposed to present it? The third one. First, what is it? Does it belong to me? Should I recognize it or not? Yes, I should recognize it. This is my asset. Let's measure it. How much it is? It is $12,000. I need to measure it $12,000. Then where do I show it? I put it on the presentation thing. And the last one is disclosure, the fourth one. The last one is disclosure. Disclosure means that what additional information we should provide about this asset. Okay, there should be some, probably there are some additional information about that particular transaction, because remember, income statement and balance sheet is one page and it is one line, and there are so many things which are accumulated. For example, in your income statement you see administrative expenses $9 million, $10 million. Now what is inside that $10 million? There might be a list of long items. When you see your cost of sales $24 million, within cost of sales, there are so many things which have been included. In income statement, balance sheet, you just have one line. In your balance sheet, you say, I don't know, some investment property, that's it, $5 million. You cannot provide all the details on balance sheet. Balance sheet is a short one-page thing, and you've got one line for investment property, that's it. Now, if you want to, the purpose is to provide information to the shareholders. I mean, not only to shareholders, to the users. And the balance sheet does not allow me to provide full information. So whatever number I put there, if I feel that I need to provide something more, some additional information, I use my disclosure notes. So you've got your disclosure notes where you show, where you, provide further information about particular transactions or particular events. So that, because ultimately the objective is to provide information. Number I have given there 5 million, but there are so many things which I need to speak about this 5 million, about this investment property. Okay, maybe some non-current assets held for sale, maybe some discontinued operation. It is
तू नहीं
on
खा
my
रही?
balance sheet, a
खाने में अपने उधर
discontinued
खाएंगे।
operation. Okay, that's $10 million, that's all. But I need to explain the circumstances under which it is being discontinued. I need to explain to the users that, I'm selling it for $10 million. If it was in the books, how much it was. If I'm selling it, how much loss I'm making, and why I'm making this loss, why I'm selling it, etc. So that everything goes to disclosure. And disclosure notes are huge. If I don't have disclosure notes, income statement, balance sheet is useless. I'm saying the word useless. You give me income statement, and it's a comparative income statement 2010 2011, and you ask me interpret this thing, understand this thing. I'm sorry, I cannot. Show me the disclosure notes. I want to see the accounting policies which you have used while making this income statement, because there are so many numbers about which I need further information, and that further information is written in disclosure notes. Remember, if you see any good company, a good normal company, their financial statements could be 100 pages, 110 pages, 120 pages. So if it is 100 pages, one page income statement, second page balance sheet, third is cash flow, fourth is equity statement, 4 pages, 4 statements, done. 96 pages are for the disclosure notes. Disclosure notes, there are a lot of valuable information, that how these 4 pages were prepared. Okay, any questions you have, you can ask me now.